The following program is to provide entertainment and information. It is not considered to be any legal or investment advice. Good morning, appraisers. Let's talk some real estate. You're listening to the Voice of Appraisal, the #1 appraisal podcast in America that brings you the latest news and information from the front lines of the real estate market. Anything from market conditions, appraisal regulations, cryptocurrencies, big bank news. Folks, if you have a question, we have all of your answers. We are the one-stop source for all of your real estate appraisal information needs. If you want to be in the know, you have definitely tuned in to the right show. I'm your host, Phil Crawford. Happy to have all of you here with us today. Kevin, how are you, my friend? What's the word today?
I am feeling just fine, even though I'm inverted.
Because I was inverted.
Because you were inverted. You were inverted, Kevin.
Because I was inverted.
Yes, Kevin, the yield curve just went inverted.
Because I was inverted.
We've got an inverted yield curve.
Because I was inverted.
I absolutely love it. It did. It inverted. It inverted for the first time in what? Since 2007? 2007. What happened? Kevin, what happened? What happened in 2007?
I think
fourth quarter.
Yeah, I think something big happened in that, but I can't put my finger on it.
I think it was a little bit of what's called fourth quarter credit crunch, 2007. 12 months later after 2007, Kevin. Oh, bad things, Kevin. Bad things. That is for sure. No, the yield curve on the 10-year Treasury has inverted, my dear friends, right now as we speak, and it's Monday, right, Kevin? It's Monday.
Yes.
You can go and get more rate of return on your money on a 1-month Treasury instrument than you can on a 10-year note. 1-month money pays more than 10-year money. That is absolutely unbelievable, and that's what you get when your yield curve goes inverted. Oh, it's terrible. Oh, it's awful. I've never seen anything like it before. Obviously, 2007 was the last time that this happened. And folks, absolutely out of control. In the midst of all of that, I know a lot of you out there have gotten the new appraiser update from Fannie Mae, and they are talking about how they're going to be able to do desktop appraisals and all part of their appraisal modernization. Just read it. Just read it. Not probably the best time to start doing things like that, especially when the yield curve becomes inverted, but that's okay. Listen, lots of good news going on with the GetMyTrueValue.com movement and the GetMyTrueValue.com community. We're going to have Sharon Whitaker. Sharon is with the ABA, the American Bankers Association. She's going to join us on today's show to discuss a lot about what we talked about a couple weeks ago in their letter to the OCC, the Treasury Department, and to the Federal Reserve. So she's going to come on, discuss some very important issues about consumer protection. But when it comes to consumer protection, that's what that GetMyTrueValue.com movement is all about. So we've got all different changes that's going on with the website right now. If you go onto the website, if you search by appraiser, the appraiser listings are now a series of icons. So the first to sign up, the first position that you get with your icon. And if you click onto that icon for that appraiser, it will open up into a landing page. Now that landing page is where you can put all of your testimonials. If you want to put a long bio there, it's a place where you can put all of your designations, anything that you want to put, the whole page is yours. And for those of you that are real estate appraisers that do not currently have a website and you need a website, well, that landing page can act as your website if you'd want to have it that way, because you can take your orders through that landing page. It's a really cool new system that we've got. It really does highlight our representative appraisers, and it's growing more and more as time goes on. Also, what's available on your landing page is anything that you have on YouTube. So if you have any YouTube videos that you want to put on your landing page, maybe a small introduction to your company or things like that, you can put them on there as well. So that link can go on there. It's a little hyperlink. If you need to have a YouTube video or commercial for yourself created, give us an email at info@getmytruevalue.com, info@getmytruevalue.com, and we can work on a series of commercials for you, just in case you need to have one created for your company. You got to send in your photographs to us and things like that. And Kevin and I can get the voiceover stuff taken care of for you. So that will be available as well. And then also we've got a new flippers tab. So we've got the new flipping commercial out, and we've got a new flipping section, our property flipper section, on the GetMyTrueValue.com website. And you can go ahead and share that amongst your social media and other places. Let me tell you something, folks. Property flipping is one of the best ways to generate income. Working with property flippers, especially those new ones, those novice flippers out there that may be getting themselves into a lot of trouble and working their rear ends off for like 6 or 7 months at a time, putting a substantial amount of capital at risk and only showing a very small rate of return.
The only thing I have to say about that,
Yeah.
Phil, Have you noticed the flipping shows on TV? They make it look so easy.
It looks easy, doesn't it? It always looks easy.
It is not.
Let me tell you, I have flipped a lot of property, and I enjoy flipping. I've just found a new flip for this year, and it's not easy. You never know what you're going to get in any type of flipping scenario. And one thing that we did talk about on the website, and this is so important, I mean, it's extremely important, all the profit that you make when you flip a property takes place at the time of the buy of the property, not the time of the sell. It takes place at the time of the purchase. You got to buy it for the right amount of money. And if you don't buy it for the right amount of money, I don't care what you sell it for, there's your profit out the door. It all comes down to how much did you pay for it, not what did you get for it. And that's very important. And we break that down in that section on the website, and also explains to consumers the difference between speculative real estate, a.k.a. a flip, also your single-family home that you live in, and investment real estate, which you make money in two ways. So during a speculative piece of real estate, you can only make money in one way, and that is you just ring the register. So you fix it up, you get it ready, you ring the register, you show your profit. If you have investment property, true investment property, those are much better because hopefully your equity position will increase in the future, so you'll make more money that way. And at the same time, you develop a cash flow. You have a monthly rent coming in or some monthly income coming in off laundry services and things like that. So that creates a cash flow. So in an investment piece of property, you make money in two ways. In a speculative piece of property, you're only making money in one way, and that is you got to ring the register and sell it. And when you put that much risk on the line and that much capital on the line, you have to make sure that you have a real estate professional, an unemotional, third-party, unbiased professional to run the numbers, make sure you're not believing your own hype, and to make sure that these consumers and these investors are going to show a profit. Yeah, Kevin.
And if you want to find somebody that's third-party, unbiased, getmytruevalue.com.
Getmytruevalue.com. That's right. And for those of you that are syndicate listeners, is Frazier coming on today? Frazier will be on next week, right?
Yes, he is. No, yeah, he'll be on
Frazier
next
will be
week.
on next week from the industry syndicate. Folks, if you are a member of the industry syndicate and you're listening, if you're a real estate agent or a real estate investor, listen, it's so important for you to connect with an appraiser in your area. Connect with one. Bounce ideas off of them. I've been flipping for a long time, and I've got two friends of mine who are appraisers and my father, who's been an appraiser for a long time, and I'm always saying, hey, look, check my numbers, check my numbers, check my numbers. Am I right? Am I going to lose it? Check my numbers.
What I was going to ask, Phil, so basically you're saying the term flipping appraiser is nothing bad.
That's right. You need a flipping appraiser. That's right, Kevin. You need a flipping appraiser. You need to get one at getmytruevalue.com. That's exactly right, Kevin. But no, industry syndicate members, make that connection. Get involved, and make sure that appraiser's contacting your smartphone. You can get them at getmytruevalue.com. Also, we're going to be working with several other vendors. Very exciting news. This will be coming out probably in the next 2 or 3 weeks. We're going to make sure that GetMyTrueValue.com is a Dodd-Frank compliant portal. So anybody out there in the banking system that wants to order directly from appraisers from the GetMyTrueValue.com network, we are working to make sure that all orders coming in through lenders and banks are, in fact, Dodd-Frank compliant, and we're working with several people on that too. So those of you that are representatives of GetMyTrueValue.com, hopefully you'll be able to see orders coming in from direct lenders as well as consumers and property flippers and everything else. Lots of exciting things, Kevin. Lots of exciting things going on. GetMyTrueValue.com is getting bigger and bigger. The marketing campaign is getting stronger and stronger. The yield curve is now inverted.
Because I was inverted.
It is inverted. I cannot believe it is inverted.
Because I was inverted.
And you got to think about this.
I was inverted.
You got to think about this for just a minute, Kevin. You got to think about this inversion for just a minute here. Let's just play this out. I'm going to get into a lot of trouble here because I'm going to play it out in a rational level.
What else is new?
I know, seriously, because I'm going to play out the markets. Now, this is not investment advice, so don't take this as investment advice. But when it's more beneficial for you to hold your money for 1 month and make more money off that money for 1 month than it is for 10 years, well, folks, you got to think to yourself, now, wait a second, what does this mean for the bond market? Because the bond market, that's exactly right, Kevin. Kevin just went all the way down. You know, I mean, in order for the yield to go up on a 10-year Treasury, what does the bond market have to do? The bonds have to go down in value. So as more and more of the long-term notes, see, money's going to have to transfer. Does it make any sense for you to put your money away for 10 years and get a lower rate of return than it would to just put it away for a month? I'm assuming eventually the money's going to transfer over into the short-term positions, and if that's the case, then the value of the bonds and the long bond is going to go down. So if it goes down, that means the yield on the bonds, the 10-year Treasury, goes up. And if a 10-year Treasury goes up, right, then what goes up with it? mortgage interest rates. So in order for this to kick back and go back up again where it needs to be, then this, what are we looking at here, Kevin? Like a 10-year Treasury yield at like 3.4, 3.5, 4%. You saw the stuff that took place in November,
Right.
3.2%, and the whole market went crazy. And, of course, President Trump's out there right now blaming the Fed on everything, going, you screwed it up. You screwed it up. It's unbelievable.
So the days of 2.5 are over.
I don't know. If I think about it rationally, you would have to say to yourself that money would leave the longer-term paper and go into short-term paper. And therefore, the long bonds would start to lose value and the yields would go up. Now, what would that do for real estate? That have a major, major impact on real estate. It slowed things down at 3.2. That was what, close to a 5% 30-year mortgage? What if this thing gets to a 6% 30-year mortgage or even a 6.5%? What if rates start to normalize for the first time? Does this mean that the Federal Reserve has to come back in and do what's called QE, quantitative easing, where they just buy the bonds up to drive the values up and drive the yields down? Is that what we do? But yet we live in this screwed up, weird world where long-term money is cheaper than short-term. I don't. This is weird, Kevin. I'm floored by it, and I'm very anxious to see what's going to happen, not necessarily now, but in the second half of 2019. That's where a lot of weird things can start to take place, Kevin, and if that's the case, I don't think that's a good time for Fannie Mae and Freddie Mac to be out there doing PIWs and things like that. You may need to have some really good, accurate valuations and some really good things going on here.
A lot of macroeconomics.
A lot of macroeconomics, that is for sure, Kevin. Listen to this article really quick here. This is out of CoreLogic, and it's talking about their delinquency report. Homeowners with equity to lose more likely to pay on time. Now, we're talking a lot about the default rates throughout the country. The default rates on mortgages have been very, very low lately. And the reason why is because when people have a lot of equity in their house, they tend to pay their mortgages. It's when the equity goes down or gets negative, that's when they kind of say, screw it, I'm not paying this thing off, let it burn to the ground, all right? This is just nothing, but it's natural human instinct.
Burn that sucker.
Yeah,
down.
it's natural for a human being to be upset when you're head over heels in debt on a house that's not worth that much. You're sitting there going, why am I even paying this mortgage off? Why am I even doing this, you know?
I don't know why, but all of a sudden I feel that we need to say, we are not saying you should burn your house down.
Oh, yeah, that's true. You have to say that, too. Yeah. Let's make that comment. This is no investment advice, and do not burn your house down. I will tell you that right now, especially if you're negative equity. Do not burn your house down. And if you make a 97% loan-to-value loan, that's subprime. You are negative equity, so don't burn your house down either. Please don't do that. But anyways, my point being is that this is so just basically human nature. People get depressed. They get upset when their house value goes down so much that at the end of the day, they stop making their mortgage payments. Now, here's the issue, and this is where we get into consumer protection. If consumers don't have the proper appraisal done at the time of their purchase to know if they're buying a home at market value or if they're paying a premium for it, which is fine, anybody can pay a premium for it, but they have to have knowledge of it, then this can become a problem. So let's say, for instance, we're in a world right now where values are at a certain level. Well, because of the inverted yield curve, and maybe interest rates start to go up over the next 6 months, what happens if values start to go down? Well, if values start to go down, people get underwater on their mortgages, and guess what? Delinquencies then go up. It's just common knowledge is what it is. I mean, I don't even know why this happens to be an article, for crying out loud. Everybody knows that it sucks to be underwater on your mortgage and still have to pay it. You have nothing to show for it. You feel like you're just drowning in this sea of quicksand of debt. And yet, that is a very good and possible scenario that we could face in this yield curve inversion if money switches one side or the other. I have no idea what the Federal Reserve is going to do. I don't know if they're going to do another QE. Remember, we've never done QE ever. Industry syndicate members, listen to me on that one. We've never done a QE. Ben Bernanke was the first one that ever did quantitative easing, which means that you just buy the bonds to drive the values up and to drive the yields down. We've never done that. We have no idea how this thing is going to end, but it could end quite badly. We don't know, okay? So there's a lot of things going on, but more than ever, consumer protection in this market, let the buyer beware. Let's make sure that the consumers have full knowledge of what they are doing, what they are buying, know before you owe, and that is very important, and we do that through the GetMyTrueValue.com marketing campaign and www.getmytruevalue.com. Real estate appraisers standing up for consumer protection in America today. So to discuss more about consumer protection, we have an awesome interview. We have on the line with us today Sharon Whitaker. Sharon is the Vice President of Commercial Real Estate and Finance for Mortgage Markets, Financial Management, and Public Policy at the American Bankers Association. Sharon Whitaker, thank you very much for being on the show today.
Thanks so much for having me on, Phil. It's wonderful to be on your podcast, so we really appreciate the invitation.
Well, no problem at all. Listen, I want to talk a little bit about what's going on in terms of consumer protection in the banking system. But first, if you wouldn't mind, tell us a little bit about the American Bankers Association.
That's a great question. Thanks for asking, Phil. We at the American Bankers Association, we're really the voice of the banking industry itself. We comprise of small, regional, large banks. They come together. It represents about $17 trillion in the banking industry. It safeguards about $13 trillion in deposits and extends about $10 trillion in loans. So you can see that's a very, very large industry. It really works directly with banks themselves. And I'm here as a liaison with the appraisal working groups, the commercial real estate, and through our mortgage markets area as well, and touch upon policy. So that's who I am, and that's what I do. I have a banking background, so what I do kind of fits well into the discussions with our various members, and all of our members are banks.
Okay, great. Well, let me ask you some more questions here. Now, just recently, the American Bankers Association put out a statement in the form of a letter to the Board of Governors for the Federal Reserve Board, the OCC, and, of course, the Department of Treasury. Now, in this letter, the American Bankers, the ABA, took a position that you were in favor of the increase of the de minimis. Now, I'm not going to get into that with you because I think you and I may find a little bit of disagreement on it, but we have a lot of common ground in this letter when it comes to consumer protection. Can you give us a little bit of background as to what it takes to put a letter like this together?
Sure, I'd be happy to.
Sure.
Within our membership, we go about talking to all aspects of our members, from the CEOs that we talk to. We have a lot of states that fly in, obviously come to visit Capitol Hill, and they come and they visit the ABA, and we find out what their voices and their concerns are. So we talk from the CEOs to all of the front-end people who really run the mortgage market's front-end line, as well as the appraisers and appraisal managers that work for the banks themselves. So we get from the operational end to the front end to actually the entire looking at it from the CEOs as well, and then try to braid together all these various views of the best way to put together a comment letter and come together with all different ways of doing business. It's not a cookie-cutter way of doing business, and hopefully the letter carries that flavor out that what works best for one bank won't necessarily work best for all banks, but optionality is extraordinarily important and for the banks.
Yeah, no, I can see
the members.
I can see that in the letter. I can see where you talk a little bit about the smaller community banks, the differences between how these things will be an advantage to them or a disadvantage to others. And one thing that just jumped out at me immediately was the comments on consumer protection, the concerns with the Consumer Financial Protection Bureau and our consumers being well served with, quote unquote, a new standard or a new way of doing appraisals. And that's very important. Right now we have the GSEs, Fannie Mae and Freddie Mac, which are not members of the ABA. I will add that. We have them doing different kinds of desktop appraisals, different kind of bifurcated appraisals, and sometimes they're doing what are called property inspection waivers or appraisal waivers. Now, all of these fall into their particular risk assessment. But one thing that the American Bankers Association did so well in this letter is basically explain what we've all known for a very long time, and that is that the appraisal that is done for the bank should not be used by the consumer in making a purchase decision. And it's stated perfectly here in the letter. It says that although there may be some ancillary consumer benefit to a bank-ordered appraisal, the reality is that, in real estate transaction, the appraisal is not ordered for the benefit of the consumer, but rather for the benefit of the lender. Consumers may and are often advised to obtain an appraisal for their own use as outlined in the purchase or sales agreement. This agreement is an example of a form that will require retooling by attorneys and realtors and will and should remain outside of regulation by federal regulators. This is a wonderful comment. I'm glad that the ABA brought it up. Let's talk a little bit about this. First of all, there was a recent court ruling out of the state of California that was known as Kendall versus Murphy. And in that court ruling, the courts decided that the appraiser that does the appraisal for the bank for the purpose of a mortgage, that appraiser has no financial duty or responsibility to the buyer when it comes to their purchase decision. You're stating the exact same thing in this letter here, and I think it's great. So let's talk a little bit. Let's talk about this new world that we're living in where we have property inspection waivers, we have different bifurcated products and things like that, and Fannie and Freddie are using different kinds of risk assessment when it comes to the valuation of property. Do you see there being a big problem with consumer protection and consumer knowledge when it comes to home buying?
I'm going to dissect that in a couple of different ways, if you don't mind. So sometimes I take the long drive to get to your answer, so if you can bear with me for a moment.
Let's take a long drive.
Thanks. I think one of the questions the regulators were very good in there when asking in the proposed rule was the concern about the consumer, and that is something when we discussed it with our members that we took into consideration, and I think that we tried to address that, and that is a concern of our members as well, especially on that purchase.
Right.
When bankers do the different types of alternatives to appraisals, they've been doing them for years for some pre-funding due diligence or post-funding due diligence,
Sure.
whether they may be selling things or even for looking at home equities for their own portfolio type lending, early payment default, first payment default. All those other ancillary tools, sometimes they're a little bit more commonplace in the banking industry. They're not always used for purchase. So the primary looking at this for the consumer protection, I think, is something that we did discuss at length and was very important to address because the regulators asked about it as well. And those appraisals have always been coming from a banking background, ordered for the purpose for the bank to use to either value that asset on their books or to look at the loan to value, whether or not they're going to make the loan or there's issues with it as well. Of course, it's in the appraisal contingency part of the purchase and sale agreement, and that specifically says appraisal. So our concern is, especially from the consumer's point of view, on a purchase, if evaluations are done or appraisal waivers are done, do the consumers know the difference? So we're looking at two different things here, the purchase and sale agreement as well as another form, the actual, is there another way to, so that the consumer knows the difference if an appraisal is not being done, but there may be something else that's being done. Hybrid appraisals are used compliant, so that may not be a concern. But what types of things do we need to be concerned about? And if it's an internal valuation being done by the bank, a lot of times more questions come about from that versus a third-party evaluation. There's so many different lines and so many different ways of looking at what may be done on the consumer, and especially that purchase level. We did think that there needs to be more work done in the industry itself.
Do you think that there may be a need for a new disclosure, perhaps, during the time of the purchase where the consumer is told specifically that this is a valuation done for the bank or an evaluation, but it is not an appraisal? Do you foresee a new disclosure coming in the future, perhaps?
We encourage the Bureau to consider a merged disclosure document that would show the consumer the difference in it, different from the purchase and sale agreement that specifically talks about the appraisal itself. But there are various disclosures that are required to be given to the consumer on the appraisal, their right to get a copy of the appraisal. So we thought perhaps they may consider blending some type of language into that disclosure. Our working group said that would be a great place for them to see there may be a differential in what may be done for this specific purchase transaction.
Okay, that sounds great. And then it's actually a very good idea because the last thing you want to do is add another disclosure to a very large pack of paperwork when someone's buying a house. It can be a little bit overwhelming. So that would be a great place to put it. Now, let's talk about the sales contract itself. I'm just going to throw a hypothetical out at you, and I want to get your opinion on this. Let's say, for instance, we have a sales contract, and there is a contingency in the sales contract. It's an appraisal contingency that the property has to sell at or above the sales price. Now, not every contract has that. Some waive that contingency, but a lot of them have it. Do you think we should look at some additional retooling of those sales contracts to say specifically which appraisal should be used to satisfy that contingency? Does that make sense? So in other words, sort of the old way of doing things. The bank would order an appraisal. The appraisal would be done by a third-party appraiser, and most of the time, all parties would use that appraisal to satisfy that contingency in that sales contract. But now we're getting into a different world with PIWs and everything else. I think there should be a common statement to define which appraisal should be used to satisfy the contingency. Your thoughts on that?
My thoughts on it are looking at some of the sample language from purchase and sale agreements. Unfortunately, they're not all standardized state to state,
Sure.
So it's very vague from state to state. And I think the various states may need to look at them a little bit more deeply as far as what's in it, because some are very, very clear that this buyer has the right to obtain an appraisal on the property. The appraisal will be at the buyer's expense. It will be formed by a blank state licensed appraiser, and that gives them the right to get out of it. So there are some that are tied into that. Some can elect to use the appraisal that is performed by the bank. So there's unfortunately not a lot of state-by-state consistency, but we're suggesting that that is something that isn't in the realm of the regulatory body. It shouldn't be in for the regulators to solve, but this is something that really should be looked at a little bit more thoroughly, because that is, if you're buying it for cash, you have the right to get your own appraisal to be sure that you are covered. That's not even considered to be part of the bank contract. Sure. But in some cases, an evaluation may be done, and that could be as well important to change that, because if an evaluation is being done and that doesn't come in, that could change what legally you could get into or not get into. I'm not an attorney. This is a little deeper for contract language than I'm even comfortable discussing.
Sure, I got
you.
you.
But it's something that came about from our members to say, you know what, as we get further down this line, this is something that we as an industry really need to discuss what is in that purchase and sale agreement, and they do vary drastically from state to state. Some are very clean, very crisp, and then some are extraordinarily vague. I think it's really good for the appraisal industry to look at it as well.
No, I think so, and we're taking a very deep look at it, because our position is that you may start to see the appraisal community switch over to more of a consumer protection type of product, where more and more buyers would obtain their own appraisal just as they would a home inspection, which the letter does bring up as well. You make that similar statement there. But I think that ultimately, at the end of the day, it's going to be very important for agents and for buyers and sellers to specifically define which appraisal will be used to satisfy the contingency in the contract. And then also, I think, and again, you and I are not attorneys, so let's not go down that attorney path, but this could be a little bit of extra liability on the real estate agents that are involved, because at the end of the day, if there's no appraisal that's performed and an evaluation is done, there could be some really big questions as if the contract was actually fully executed or not. And that could run into a lot of problems with the real estate agents. So I think you're right. I think a retooling by attorneys and realtors of all of the many, many different sales contracts out there in the country is going to be very important and on the horizon. And I think that the appraisers should make a very big statement when it comes to those contracts. Your thoughts?
I agree with you. I think that it's something that as we continue, these alternate tools have been used for years, but for a variety of different purposes. As if this proposed rule does go through, and if it does not, it still is a concern, because there is some of the population that is used on this. And I think we're going into a world where, from the Treasury report that was done in July, and I think there's more and more things that are going to happen with technology, that we need to be aware of our surroundings and all of the things that touch in on it, and what needs to change as technology changes the world around us.
I totally agree with you. I think it's very important, and we have to make sure that consumers are protected and they have good knowledge of what they're getting into, the contracts that they're signing, and all the responsibilities that they take on as this technology changes throughout our industries. And at the end of the day, it's all about disclosure, and I'm glad that the ABA is out there talking about this, because this is something that appraisers have been talking about for a very long time. We've started a new marketing campaign, a nationwide marketing campaign called GetMyTrueValue.com. And from that campaign, we are getting the word out about consumer protection during the home buying process. And even though some of these products that the banks are using may satisfy their risk assessment, we do need to make sure that the consumers are satisfied in their decisions when it comes to purchasing a home. Sharon, I appreciate you coming on. It's been a real honor. Would you please consider coming on again and being a regular guest? This is a good area of common ground that we have between the American Bankers Association and the real estate appraisers across the country. And I'd like to keep the dialogue open with you.
I thank you for that. Lenders and appraisers are all part of the team, and we all work together, and we work together to make the industry a partnership. And that's what we're about here at the ABA, is working with all different areas to really get that process and make it better. So I can't thank you enough for having me on, and I look forward to talking to you again in the future.
Well, thank you, Sharon, very much. I know you're traveling this week. Am I right about that? So safe travels.
You are right about that. Thank you very much. I appreciate it. Hope your weather's good there.
It's not. It's raining right now, Sharon, but there's nothing I can do about it. But listen, have a great day, and thanks again.
Okay.
So there was Sharon Whitaker with the American Bankers Association. We were so happy to have her on. Kevin, I don't know. What do you think? I think consumer protection is going to be a big, hot topic in 2019. I think the appraisers are right there, right where we need to be.
I think with Get My True Value, we're really ahead of the game.
We're ahead of the game on this thing, aren't we? We saw it coming. We knew it was going to be an issue. Is there going to be retooling of sales contracts throughout the country? I don't know. Is there going to be a new disclosure? It sounds like there may be a new disclosure coming up for consumers about that appraisal and who does it and what's it done for and who owns it and all of these things. I think this is very, very positive for the appraisal community. But I'll tell you something, with all the interesting macroeconomic issues that are going on in the country, consumers are going to need to have good valuation consultations before they purchase their home. It's going to protect everybody. It's going to protect the bankers. It'll protect the realtors, industry syndicate members. It's going to protect you. It'll protect everybody if the consumer has their own appraisal done at the time of the purchase. And that's what GetMyTrueValue.com is all about. So that's it for today's show, Kevin. I'm going to be traveling over the next week. I'm going to go down to Atlantic City at the ASA conference down there in Jersey, the Jersey Boys, with the American Society of Appraisers. I'm going to be breaking down antitrust. I'm going to be talking a lot about consumer protection. And we're going to be breaking down the blockchain. The blockchain, Kevin. What happened to Bitcoin, by the way? It stayed steady, didn't it?
Stayed steady.
It stayed steady today. Bitcoin's staying steady, and we're going to talk a lot about property tokenization, how that's going to affect us as real estate appraisers going forward over the next couple of years. And, folks, I tell you, I'm going to break it down in Atlantic City with John Russell and the good people of the American Society of Appraisers on March 10th and 11th. Come and join us at the Tropicana. It'll be a good time. So, ladies and gentlemen, we have come to the end of our show for this week. And as always, I would like to thank you for listening as we journey through the mysteries and complexities that are, in fact, the real estate appraisal business. I would like to thank our guest, Sharon Whitaker from the American Bankers Association, and my producer, Kevin Kinney, for being here for his thoughtful insight and knowledge. God willing, we're going to be back here very soon, continuing to report from the front lines of the real estate market. In the meantime, you kiss your spouse, you hug your children, enjoy your day, be safe in the field. You've been listening to Phil Crawford on Voice of Appraisal. We'll talk very soon.
Because I was inverted.